Good afternoon. I'm Anuj Mehrotra, Dean of the George Washington University School of Business, and it is my pleasure to welcome you to this episode in the George Talks Business Series. We are continuing our series on artificial intelligence today, and I am delighted to introduce our distinguished guest today, Melissa Koide, CEO of FinReg Lab. Thank you for joining us today, Melissa.
It's a pleasure to be here today, Dean. Thank you for inviting me.
Wonderful. So, in this mini series on artificial intelligence, we have talked about the AI and the problem of control, as well as AI from the standpoint of policy, digital equity, privacy, and ethics. And today, we want to talk a little bit more about AI, how AI is transforming the financial services. But before we get into this, Melissa, I'd like to ask this question of each of our guests. Could you talk a little bit about your career path, why you founded FinReg Lab, and a little bit about your current role and about FinReg Lab itself?
Well, that is a lot, and that could take a good 30 minutes, but I have come prepared. I'd be happy to give you a little bit of background because I think it should provide some helpful insight about the organization that I established just about 4 years ago. I've been in and outside of government for most of my career, specifically sitting at the U.S. Treasury Department, both as a career civil servant and then most recently as an appointee in the Obama administration. And it was just at that point in time when this term fintech was hitting the scene. And we had non-banks that were using data in new ways, and there was a lot of data to be potentially accessed and brought into how financial products and services were being offered. And there were new technologies that were emerging. And we sitting on the government side, were hearing lots of arguments about how things like, for instance, virtual currency could be the way that we solve global financial inclusion. We were hearing arguments on the other side, for instance, that consumer data privacy is dead, right? Advocates were coming in arguing we really need to clamp down on how data was being used, including in the financial system, in ways that, data privacy expectations weren't being met. And so there were all of these arguments, but what we really lacked was any source of information that we policymakers could turn to get empirical, fact-based insights about what a particular data use or a particular technology would actually do in terms of consumer benefit, consumer harm, market implications, market dynamics, and ultimately what that meant in terms of how we then thought about evolving public policy, both legislation and regulations. And so it was with that need that after leaving Treasury, my second time around, I decided to stand up this organization as a nonprofit research organization that could go out and deliver these timely, fact-based research projects that would bring those facts to the broad community and frankly, all of the stakeholders who are going to have a hand in how public policy evolves. So that means the banks, the incumbents, it means the consumer advocates, it means the fintech sector, it means the big tech sector, and it means engaging academics who also are important contributors to how we know and understand implications of data and tech in financial services.
So clearly you found a big gap to fill here, and you mentioned academics and you mentioned research, and I know you are working with some Stanford folks on a project focused on explainability and fairness of machine learning on credit underwriting. Could you talk a little bit about the driving force, the rationale for this project? What are some of the issues that you're trying to address?
Absolutely. And so, as I just mentioned, there were a lot of arguments about how new technologies like machine learning and AI may be really productive and effective at doing things like identity verification, which is a requirement in the financial system, or better credit risk assessing, which is a necessity when you are trying to make sure that loans are being made prudently and that the borrower on the other end is going to be able to repay it. There are so many really promising applications of AI, machine learning, and the use of data. But again, really trying to pull that apart and understand what the implications are is something that we're all sort of grasping for and need empirically based insights. And so when we think about, for instance, the use of machine learning and AI in the financial system, one of the most sensitive and I think really important aspects where machine learning and AI can be deployed is in the lending area. That's important both because, again, we want prudent lending, both for the benefit of the borrower and the lender, but we also want a safe and sound and stable financial system. And so that means when we think about deploying models that may be more opaque, machine learning models, and there are a variety of types. And when we're talking about bringing in new types of data, we have lots of questions about how those algorithms and the data that are being used prudently, safely, and with all of the expectations we have around evaluating for consumer protection purposes, things like fairness, things like inclusion. And so, with that really important set of questions, what we are doing through a project that we will be embarking on this year is really to evaluate how do not only these different types of machine learning algorithms for credit underwriting, how do they work? Important questions around are they predictive? But ultimately, the deployment of machine learning and AI, especially in something like credit underwriting, it comes back to having confidence in how those models are working and the ability to understand how they work and how they are producing the outcomes that they produce. And so the sort of shorthand way that we go about thinking about the need here is this need for explainability in AI and machine learning. And so what we're going to be doing is actually looking at how these different models can be explained, if they can be explained, as sort of a first order question. Some of the more complex models may be a lot harder to explain, but we're really going to dig in and evaluate the ability to explain for these public policy purposes that we have. How do the models generate outcomes that are then sort of, we can have a level of confidence in terms of explaining to the consumer why they are getting a certain credit decision that they're getting. That's actually a legal requirement, which is notable. I mentioned model stability and the robustness of the models, really core questions from safety and soundness expectations. Again, these are financial regulatory requirements. And then really importantly, and it's so wonderful to see how much attention that we're all giving to the need for making sure that we don't have discrimination in the decisions that are made. You really need to be able to explain how those models work for evaluating for potential risks of disparate impact on protected classes. And I'll note again, and I know we're going to talk about this, but that too is a legal requirement that exists when a firm is lending, providing credit to borrowers. And so those are the kinds of really core questions that we're going to be evaluating. And I think it's going to have really important insights in terms of how well these models can be explained, not just in the credit underwriting space, but in the application of machine learning models that are deployed in lots of different cases across the financial sector.
Yeah, no, very, very interesting research. And in fact, let's actually talk about that. You mentioned, of course, this topic has come up in various conversations with folks. This is very interesting research. There is growing concern, and you hinted on that, and the potential, and a concern about the potential for these AI and machine learning algorithms to really reinforce biases. You mentioned there's also concern on how some of this, how newly accessible data is changing the outcomes for protected class populations. So it would be great to hear that connection through perhaps some example. For example, what would be the implications for home ownership with such biases in the algorithms? And this is very interesting research to dive a little bit deeper into it with examples.
Yeah, and bias is actually, it's got a lot of different definitions underneath it. I mean, there are statistical biases that have to be accounted for, and that gets to potential risks, both in terms of disparate impact outcomes, but also statistical biases that may actually have bearing on whether or not the model is stable and stable over time as data changes. I mean, think about how, for instance, the data, the circumstances that so many households are in and how their information and their data has changed, employment as a for instance. So bias can sort of invoke a lot of important considerations when using machine learning in credit underwriting, whether it's for homeownership or even credit cards or even shorter term credit access, which is an important piece. As we found out some of these societal and policy questions that we need to be answering when we are deploying AI and machine learning in especially credit underwriting, we also think about just how important it is, or how important different aspects of fairness are, and how we think about fairness when we are using new types of data and also, again, more opaque algorithms. And so we think about fairness from mitigating risks of protected class populations being treated differently as compared to non-Hispanic whites as sort of your benchmark. We think about fairness in the context of just how important it is to make sure that the data that you are putting into your algorithms really are representative of all populations, because there too, if your data aren't reflecting the people who you want to be serving and credit risk assessing, you're going to be missing important swaths of the population. And this is, in fact, where some of the work we've done in the past is a really important precursor to even this work looking at the machine learning algorithms. We think it's important to sort of separate out and evaluate the data, and where new types of data may be really useful for bringing in more people into the financial system, but also really probing that data to understand, do they create fairness and bias issues? And so we had looked at and evaluated what is called cash flow data. It's basic information that we all sort of generate in our bank accounts. It's also very timely information as comparison to credit bureau data. It's also the fact that more people have transaction data than necessarily have credit histories. And so when, again, this point about inclusion, this looking at cash flow data may be able, well, we actually have found that it can enable lenders to credit risk assess populations who otherwise would have been denied if they were relying on credit bureau data. So we separate out and ask the questions about the data and where the fairness and inclusion implications are there. And then this research that I'm talking with you about now is about evaluating the techniques, these machine learning algorithms. And then over time, we will be evaluating both the algorithms plus this cash flow data to really understand the inclusion effects, the fairness implications, the questions around explainability, because again, that is a necessity when you are extending credit. And all of these present sort of a really big opportunity in terms of making sure that we do have a fair and more inclusive financial system, but also really understanding how you explain what's coming out of these models so that you can assess them for fairness and ensure that information is communicated to consumers that they need in terms of credit decisions that are reached about them.
Great. So, I also tend to think, of course, and correct me if I'm wrong, but the financial services is really a very highly regulated industry. And perhaps, therefore, some of these things are somewhat more easily tackleable in the financial services industry as we understand the implications for AI. But I would think that some of the best practices that you might find associated with financial services industry might be applicable, and there may be certain lessons learned to apply to other industries. And it would be great to hear some of your thoughts on how they might translate and whether that makes sense to take a highly regulated industry where you study this well and then perhaps transfer that best practice and knowledge to other industries.
Yeah, we co-hosted an event a year ago with the San Francisco Federal Reserve Bank, specifically at data and both sort of the potential benefits around consumer data access for financial purposes, and also some of these important implications of the data. And as we put that event together, we wanted to make sure that we were also sort of looking at different sectors and how those different sectors contemplated data privacy expectations and data access opportunities and needs. And it was really striking, frankly. It's not to say that there aren't laws and regulations in the use of data in other sectors. But it was really striking how helpful some of the financial services or financial institution laws that we have in place really help to push anybody who is using AI or ML and new types of data to evaluate for some of these expectations that we all have around data privacy, data security, explanation, as I just talked through, for how decisions are determined when a financial firm is lending or making determinations around product access. And so it's also notable that the world is now paying so much more attention to AI and more opaque models and algorithms that are used in lots of different use cases. We don't necessarily see the laws and regulations really drive some of those questions that are arising. So I think about some of the cases that have come up, and especially in the healthcare sector. I mean, we do have some data protection laws. Obviously, HIPAA is a big piece of that. But there have been real concerns about how some of the algorithms and the data that are used for making some health decisions really are having unintended outcomes, I believe is the case, but nevertheless resulting in bias output. And I think, if, for instance, in healthcare, and I'm not arguing or advocating that we need to totally model exactly what we have in the financial services regulations over to healthcare, but I think the fact that we have explicit laws that would lead, for instance, a lender through a process of evaluating the models they're using, understanding if it is creating these differences between protected classes and non-protected classes, then sort of a further step pushing a lender to evaluate, is there another way to get sort of a similar business outcome with less sort of disparate impact or disparate effect? I think if we had some of those guardrails in place in some of these other sectors, we might sort of have a little more confidence and even certainty in terms of how some of these more opaque algorithms and the data that are being brought in, how they're being used in some of these other sectors. I also had mentioned to you last week, it's also somewhat notable that as we have engagements and partnerships with financial firms who are, advertising products through partnerships with big tech companies, as an example, say for advertising or marketing, our laws and our expectations around how just to call it a bank, but how a bank has to know and understand how its vendor is building models and using data, I think is an interesting sort of carryover and aspect of how having real certain definitions around avoiding discrimination, how they may be helpful in carrying over to other sectors where we have these partnerships between regulated financial firms and non-regulated entities.
So you bring a very interesting point there, and I've always wondered, with so many exchanges and so many dimensions to this, who is bearing the responsibility of how we are deploying AI in financial services, and how do we govern AI? If you could share your thoughts on AI governance and perhaps regulation globally, that would be interesting, because what is applicable in one country may not be applicable in another part of the world, and who is, at the end of the day, who is governing this development and deployment of AI in financial services?
Yeah, I wish I had a lovely pat answer for you on this. It's really, really complicated, and the complications are problematic, problematic in some ways and potentially beneficial in other ways. We do see globally data protection laws that have come into place. GDPR in the EU is a big one. We also globally see certain countries really want to hone in and establish data privacy protections and what they call data localization efforts, which mean that sort of the data that are being generated by people in those countries have to stay within those countries. And that's in part it's got many dimensions to it, but in part, it's a defensive stance in terms of just making sure that people from those countries, their data are protected. Um, when we think about the financial system, especially at the federal level, and especially at Treasury, you're also talking about financial firms that are operating globally and have the need to be able to meet many obligations, including really important ones around anti-money laundering needs and really sort of mitigating the risk of terrorist financing through the financial systems. And an important part of that is around being able to understand and mitigate those risks. And so when we think about now both the potential of data for better understanding risks and then the potential of more sophisticated analytical techniques like AI and ML to potentially help to spot those risks, you can see why having more consistency, or if not consistency, some level of agreement between countries in terms of what those laws and expectations are, both around data and around the techniques that are being deployed, how important that is. We even see this at some level, some of the challenges even in our federal system, where we have obviously states with their own authorities in regulating financial firms, and the federal financial system that we have. And there are a lot of calls for greater consistency between state law and federal law around sort of expectations for purposes, especially around consumer protection. And that's a really complicated issue. I think the potential of data and these more advanced analytical techniques, but also the risks, really puts more of a recognition that we do need to have ultimately consistency across jurisdictions. But I'm thinking a little bit about Stuart Russell's interview with you recently, where he was arguing, and I can appreciate this, that we really need to know how, where the risks are, where the benefits are of AI, and let's make sure that we get that well understood or better understood than where we are today. And then we think about how do we build those laws and rules that ultimately will govern the deployment of AI and the data that are brought in.
So I'm glad you mentioned the conversation with Stuart Russell. So let me ask you a similar question that I asked Stuart Russell, but with with consumer financial data. What could go wrong? What could go wrong, and how do you see that it might impact on how we control our digital identity in the future?
Yeah, these are such great big questions. What could go wrong? I mean, one of the things that I worry about is that we actually miss the opportunity and that we fail to govern the AI and the data use appropriately and well. And so making sure that we do have the safe space to understand where the technology and where the data may be productive, right? Whether it's doing better identity proofing. Are you who you say you are? It's a requirement to be a part of the financial system. Really understanding how data can be used, and we think about something federated machine learning as a way where there's a privacy enhancing way that algorithms basically can learn from lots of different data sources, so that you could actually do better risk mitigation, risk spotting across different data sources. I think there's just a lot of need to better understand, and I'm hopeful that we're going to give ourselves the space to really evaluate these opportunities, while still really importantly thinking about how are we getting consumer data protections right. And again, I come back to thinking about how the financial, legal, and regulatory system is a really sort of helpful way for firms to push against and evaluate themselves for these consumer protection needs. But I think one of the areas that is clearly some space that we need to be thinking about, both in the financial sector, but also more broadly, is around data and data protection and data access. And Right now, the CFPB, the Consumer Financial Protection Bureau, at the federal level, has the legal authority to write rules that ultimately can help to unpack consumers' ability to access their data, their financial data, their ability to share that financial data with others. Um, I think some of what they may do or can do are some of the first important steps to making sure that the data is able to flow, but it's able to flow in ways that are and uh, ensuring consumer protections.
Great. So there's one other question that came from the audience that I want to pitch to you as well,
Okay.
wanting to really learn about how AI and financial technology is impacting small businesses. And what are some of the recent developments and trends you might be finding, especially during the pandemic, as they're impacting small businesses?
Great question. And we have actually done some work also looking at small businesses and their need for access to credit. And there's a lot more work to do around that. Um, Small business lenders, for a few different reasons, I think have been a little more forward leaning, and at least some of them have, in terms of their use of machine learning and their ability to go and access a lot of different information about the small businesses and the small business owners to be able to more finely credit risk assess and get more credit out to small businesses. And I think that's been really instructive and I think helpful to see. Um, I think there are also real concerns that we don't have similar protections in place for small businesses. I mean, think about, I want to say, off the top of my head, most of our small businesses are actually very, very small businesses, right? It's often sort of an individual who's opened up their own shop and may or may not have a handful of employees. And so it really is individuals. And so good, there is good attention and good concerns to how we make sure that we have consumer or small business protections that probably look and mirror more of what we see on the consumer protection side. The pandemic is raising lots of important questions around how these small business owners, one, are they going to be who's able to sort of maintain the business through the pandemic, and then ultimately how they're going to come out the other side. And I think this is where using data and more advanced analytical techniques may be really helpful for credit risk assessing those small businesses so that they are getting the credit they need to get back on their feet. So I would say real need for paying attention to what the small businesses and those owners will really need to come out the other side.
Yeah. So, Melissa, it has been just a pleasure talking to you, and I'm really impressed with some of the impactful research that you're pursuing, very important in this field. But I know we have run out of time, but I do want to ask you one last question, if I may. How can our students and even some of our researchers, work on certain ideas that you are pursuing, and how can they be more involved with perhaps FinReg Labs research?
Well, I appreciate that question. First of all, we are based here in DC, actually pretty close to GW. And we do bring on students every year. And so we would love to hear from your students, those who may be interested in getting closer and helping us as we look and learn and bring insights to the broader financial ecosystem. I also was struck by Stuart's comments about, what young people should be pursuing right now. Should everybody be out there after, a computer science degree or not? I thought he had some interesting comments about just how important it is, the sort of the future need for being able to be empathetic and communicate with others as one human to another. So if your students have not listened to that interview, they actually should go back and listen to it, because I think he has some really useful insights about the world may not need a million other computer scientists, especially when the machines are quite active, but we will always need people who understand other people. So give it a listen if you haven't.
Right. Well, thank you, Melissa, for this great conversation. I truly enjoyed talking to you. I would also like to
Yeah.
thank all of you who joined us today and invite you to the next episode of George Talks Business. On Thursday, I will be joined by my co-host, Lynn Goldman, Dean of the Milken Institute School of Public Health, for a conversation about AI and healthcare. Our distinguished guest will be Dr. Daniela Witten, Professor of Statistics and Biostatistics at the University of Washington and the Dorothy Guilford Endowed Chair in Mathematical Science and Statistics. We hope you will join us then. Thank you again.